Global Gold for those that are based in America and Canada. And for those in the UK and Europe, we have Orvesta. Get yours now at charlies.gold.
Hi guys. What you're about to hear explains something most people in the markets completely misunderstand. When silver moves the way it just did, people panic. They shout manipulation. They say it's impossible. But there's a reason that this happens, a very real one. So listen carefully. This will change how you see the markets move from here on out. Let's get into it.
Stop. Don't blink. Because if you're watching silver right now and thinking, this is just normal market noise, you're about to get steamrolled by the same mechanism that crushes people every single cycle. Silver didn't just wobble. It got hit, it snapped, and it's still vibrating. And the reason matters more than the price. I wasn't even going to record today. I've got a full schedule, and I'm not in the mood to do another "The Market is Scary" video. But then I saw the way people were explaining what happened, like it was some cosmic accident, like math broke, like the universe glitched. And I thought, no. If you're here, you deserve the full story, not the soothing bedtime version. It's Wednesday, February 4th, and the time in New York is 5:09 a.m. Comment what time you're watching this because I want to see where you're tuning in from and how wide this message is traveling. Now here's what set me off. Over the last few days, I've seen a flood of posts and clips saying things like, "This has never happened. The model is broken. 10 Sigma Day. Statistical impossibility. Black Swan." And when you see those words next to a chart that looks like a heart monitor during a panic attack, it's understandable to feel sick. But the mistake is the conclusion people draw next. They see the violence and assume it means the thesis is dead. They assume volatility equals failure. They assume the whole move was fake and now it's over. And that mental model is how you end up selling into the hole and buying back after the bounce, like a professional donor to someone else's profits. And here's what the headline chatter never admits. Markets can be perfectly functional and still feel completely insane. A system can be working while it's transferring risk from one balance sheet to another. When you understand that, you stop searching for villains and you start tracking incentives. Who is forced to act today? Who has optionality to wait? Who benefits if price overshoots? Those questions will beat any viral statistic. Watch incentives over coming sessions closely. So I'm going to break this down in the same way I approach any event like this. First, what actually happened in the tape and why the impossibility framing is misleading. Second, what the real mechanics are. What forces create these monster moves in silver more often than people think. Third, what I'm watching next, and what you can do so you're not emotionally whipsawed by every candle. And along the way, I'm going to challenge a popular claim from that competitor-style narrative, that volatility is automatically good. Volatility can be a sign of repricing, yes. It can also be a sign of instability and a warning that leverage is about to get punished again. The difference is context. If you miss that, you'll miss danger for opportunity or opportunity for danger. All right, let's start with the Sigma obsession because that's where the fear is coming from. You've probably seen it. Somebody takes a one-day move, compares it to a textbook bell curve, calculates a z-score, and then says, "This should not happen in the lifetime of the universe." That line gets clicks because it sounds like forbidden knowledge. It also tricks your brain into thinking, if this is impossible, the market is broken, therefore I should exit. But there's an obvious question hiding in plain sight. If reality and the model disagree, which one is wrong? Reality wins. Every time. The model is just a map, and silver is not a city built on perfect grid lines. Silver is a mountain road with fog, ice, and a cliff on both sides. The bell curve, normal distribution, assumes that extreme moves are incredibly rare and that returns are nicely symmetrical, with thin tails. That works for certain kinds of controlled processes. It is famously terrible at describing markets under stress. Silver, specifically, is a repeat offender. It has fat tails. It has volatility clustering. It has regime changes, meaning the probability of extreme moves is not remotely as small as the normal model claims, especially when the market is in a repricing phase. Here's a plain English way to understand it. In calm periods, silver behaves like a relatively normal market. Small day-to-day moves, mean reversion, and the kind of volatility that makes people yawn. But when silver shifts into a repricing regime, it stops acting normal. The distribution changes, the average changes, the volatility changes, and the extreme days arrive in packs, not as lonely unicorns. So when someone tells you, this is a 10 sigma event, what they're really saying is, I used a calm regime ruler to measure a storm regime world. Of course it looks impossible. It's the wrong ruler. And this is the part that should immediately change the way you manage your risk. Tail events in silver are not once-in-a-million-years events. They're career events. They happen often enough that if you participate for long enough, you will see multiple brutal up days and brutal down days. That is not a bug. That's the asset. Now, does that mean you should love volatility? Not blindly, but it means you should stop being shocked by it. Shock is expensive. Preparation is profitable. So why does silver behave like this? Why does it generate these insane days far more often than the textbook says it should? Because silver sits at a weird crossroads of forces that amplify each other. It's a monetary metal and an industrial input. It's heavily traded in derivatives. It attracts leverage. It trades across global sessions where liquidity changes. And it's a favored arena for positioning wars. Let's talk mechanics. Silver's paper market is huge compared to the physical market. Most price discovery happens through futures and options, not through people handing each other bars. That means price is set by contracts, margin, and risk management rules. And those rules can change fast. When volatility rises, margin requirements can rise. When margin requirements rise, leverage participants must either post more collateral or reduce exposure. In a crowded trade, a lot of people are already near their limits, so they don't calmly rebalance. They get forced out. Forced selling is the key phrase. Forced selling doesn't care about your thesis. It doesn't care about fair value. It doesn't care that you read a thread that says silver is going to the moon. Forced selling only cares about meeting requirements before the broker hits the button. And that's how you get the waterfall. One group gets forced to sell, price drops, that triggers stops and margin calls for the next group. They sell, price drops more, and the chain reaction builds. Meanwhile, algorithms see momentum and accelerate it. Options dealers hedge. Volatility spikes, liquidity thins. The move becomes self-feeding for a period of time. Then, here's the part people don't understand, you often get the snapback. Because once the forced selling exhausts itself, the market realizes the price overshot. Shorts take profits, dip buyers step in, hedging pressure reverses. And because liquidity is still thin and volatility is still high, the rebound can be just as violent as the drop. That's why you can get a day that looks like the world ended, and then a day that looks like nothing happened. And both can be normal for silver in a repricing regime. Before we go any further, I want to do something that almost nobody does when markets get loud. I want to show you why the rare event framing is emotionally persuasive and why it keeps repeating. Because this isn't just about silver. This is about how humans misread risk. When you hear 6 sigma or 10 sigma, your brain translates that into, this is a one-time freak accident. And if it's a freak accident, then the correct move is to step away. But markets don't hand you freak accidents on a schedule. They hand you clusters. They hand you seasons. They hand you regimes. Here's the part that will make you uncomfortable. If you participate in volatile markets long enough, you will see multiple impossible days. Not because the universe hates you, but because the distribution is not normal and because the inputs are not stable. Silver's distribution has thicker tails because the ingredients that drive it are lumpy. Liquidity isn't constant, participation isn't constant, leverage isn't constant. Macro shocks don't arrive smoothly. And when those lumpy ingredients combine, the outcome is lumpy too. So if you're using a model that assumes smoothness, you're going to be shocked by lumpiness. That's it. Now, let's talk about what people were actually reacting to, not the math, the feeling. The feeling was, if silver can drop like that, it can drop forever. That's the emotional story your nervous system tells you to keep you safe. But markets don't work on feelings. They work on positioning and constraints. And here's a constraint that matters a lot. In silver, the marginal price setter is often not the long-term investor. It's the leveraged trader in the derivatives market. That means the people who get forced to act can move price more than the people who want to act. So when you see a massive down day, ask, was this discretionary selling or was this forced selling? Because if it was forced, it doesn't tell you the same story. And how do you tell? You look for fingerprints. Fingerprint 1, speed. Forced selling tends to be fast. It doesn't negotiate. Fingerprint 2, breadth. It tends to hit anything linked to the position. Related metals, miners, leverage products, option structures, because the forced seller is reducing risk across the board. Fingerprint 3, reversal. After the forced wave clears, the rebound can be sharp because the marginal seller is gone. Now, none of that guarantees the next move is up, but it tells you what kind of move you just witnessed. All right, now let's talk about the hidden accelerant, options. Silver's options market can amplify moves through something called hedging flows. If you've ever wondered why prices sometimes move like they're magnetized to certain levels, or why a move accelerates after a key break, options are often part of the story. When traders buy puts for protection, dealers who sold those puts may hedge by selling futures as price falls. That selling pressure can add fuel to the decline. On the way up, the reverse can happen. Dealers hedge by buying as price rises, which can accelerate rallies. It's not magic, it's risk management. In high volatility moments, those hedging flows can become dominant, and it makes the market feel like it's slipping on ice. Now add another ingredient. Liquidity changes across the day. Silver trades around the clock, but it does not trade with the same depth around the clock. There are times when the order book is thick and times when it's thin. If a big move starts in a thinner window, it can gap through levels that would normally slow it down. So you can have a market where nothing fundamental changed in an hour, but price moved like a trap door opened because the structure was vulnerable in that window. Now, I'm going to give you a short list of the exact mistakes I see people make during these episodes, and I want you to listen like it's a checklist you're going to use the next time. Mistake 1. They interpret volatility as information about value. It isn't. It's information about stress. Mistake 2. They average down automatically without a plan because it's cheaper. Cheaper is not the same as safe. Mistake 3. They chase the rebound to make it back, which is the most dangerous emotion in markets. Revenge trading dressed up as investing. Mistake 4. They anchor to a single price level like it's destiny. Markets don't owe you your entry back on your schedule. Mistake 5. They use leverage in a product designed to punish leverage and then act shocked when it punishes them. Now, let me make this more concrete with a quick walk through a typical repricing sequence. This is not a prediction. It's a pattern. Step 1. The thesis builds quietly. Industrial demand trends up, monetary conditions shift, or supply responds slowly. Price rises steadily. Step 2. The trade becomes crowded. More people notice. Leverage creeps in. Headlines get louder. Volatility starts to pick up. Step 3. A catalyst hits. Sometimes it's macro. Sometimes it's a policy signal. Sometimes it's just a positioning imbalance. Price drops sharply. Step 4. Forced selling does its work. Stops trigger, margin calls hit, the weak hands are cleared. Step 5. The market rebounds violently, not because the story is fixed, but because the forced sellers are gone and the remaining participants are negotiating a new level. Step 6. The market either consolidates and continues, or it fails and grinds lower. That's where your anchors matter. If you're watching only step 3, you'll think the world ended. If you understand the sequence, you'll stop being emotionally manipulated by it. Now, let's bring in some broader context because silver doesn't move in isolation. It sits inside a bigger machine. In the last few years, we've seen a recurring theme. Whenever the market starts pricing in tighter policy, the currency strengthens and risk assets wobble. Metals can get slapped. Then, if growth fears rise or liquidity expectations return, metals can bounce hard. These cross currents can flip quickly, which is why silver can whipsaw harder than gold. Also, silver's identity crisis matters. Is it money? Is it an industrial commodity? It's both. That means it can be pulled by two different narratives at the same time. In a recession scare, industrial demand worries can weigh on it. In an inflation or credibility scare, the monetary bid can lift it. That tug of war is another reason volatility can explode. Two crowds are trading two different stories. Now, here's the counterpoint I promised, and it's important because it keeps you honest. Some people act like every sharp drop is a deliberate shakeout, and every rebound is proof the next leg is inevitable. That's a story people tell to avoid uncertainty. The reality is more annoying. Sometimes the market is repricing higher and the drop is a shakeout, and sometimes the drop is the start of a longer digestion phase where the market needs months, not days, to rebuild. So how do you avoid fooling yourself? You stop using a single indicator as a religion. Volatility alone is not a thesis. Volatility is a condition. The thesis comes from supply, demand, and monetary dynamics. Volatility is the weather you experience while the thesis plays out. Now, let's add fresh data-style context without turning this into a citation contest. Based on recently published numbers in the public domain, global solar deployment has continued to expand over the last few years. And while manufacturers have worked to reduce the amount of silver per panel, the scale effect still matters. At the same time, electrification trends and data infrastructure growth increase demand for conductive components. None of that means silver only goes up, but it does mean there's a baseline industrial pull that doesn't vanish just because the chart had a rough week. On the supply side, according to the latest publicly available filings and industry updates, new mine projects often take many years to move from discovery to meaningful production, and a large share of silver comes as byproduct output, which limits how directly supply can respond to silver's own price. That slow response is one reason deficits can persist longer than people expect. Now, I'm not saying deficits guarantee price goes up on a clean schedule. Markets can stay irrational. Markets can overshoot. Markets can front run and then mean revert. But it does mean that if you're betting on a structural story, you shouldn't let one volatility burst erase your conviction unless the anchors change. And here's a practical way to watch for anchor change. Look for evidence that demand is weakening materially or supply is ramping materially. Not tweets, not vibes, evidence. If demand is actually collapsing, you'll see it in industrial consumption trends and in how the market prices forward risk. If supply is ramping, you'll see it in project guidance and in inventory behavior. One more thing. The avoid it because it's volatile take sounds prudent, but it's incomplete. Volatility is not the same as risk if you size correctly and you have a horizon. Volatility is motion. Risk is the probability of permanent loss relative to your plan. If you're over-leveraged, volatility becomes fatal risk. If you're appropriately sized, volatility becomes noise you can survive. That's why two people can look at the same chart and have opposite experiences. One is forced to sell, one can wait. Now, I'm going to sprinkle in a little embedded link style insight here, because this is where the debate usually gets sloppy. Based on recently published numbers in the public domain, industrial demand for silver has been elevated in recent years, with solar, electronics, and broader electrification playing a major role. At the same time, mine supply doesn't jump instantly because much of silver production is tied to other metals as a byproduct. That creates a backdrop where price can be sensitive to shocks, and where a crowded derivatives market can violently overshoot in both directions. But here's the skeptical alternative perspective you need to consider. Sometimes these violent moves have less to do with a grand repricing story and more to do with leveraged speculation playing chicken with risk controls. In those cases, volatility isn't a sign that the thesis is right. It's a sign that the market structure is unstable and prone to liquidation events. That's not bearish or bullish by itself. It's a warning about how you should size and how you should expect the path to behave. Now, let's connect this to the last few days. We had huge down moves and then a sharp rebound. People use that to argue two opposite things. One crowd said, "See, the model broke, avoid it." Another crowd said, "See, repricing confirmed, load up." Both crowds are missing the more useful question. Which regime are we in, and what does the regime usually do next? In my view, we're in a volatility expansion regime. That means big swings can continue even if the longer-term direction eventually resolves higher. And that's why, if you're going to be involved in this market, you need a plan that survives chaos, not a plan that only works if the chart is polite. So what should you pay attention to if day-to-day candles are basically a psychological torture device? I use 5 anchors. Anchor 1, structural balance. Is the market running tight over time? Are deficits persistent? Are inventories trending in a direction that signals stress or relief? You don't need perfect data to think about this. You need consistency. Is the world repeatedly consuming more than it produces? And is that being met by stock drawdowns or by new supply? Anchor 2, the buyer mix. Are we seeing demand driven mostly by momentum traders or by longer-term allocators, industrial users, and strategic accumulators? Those groups behave differently. Momentum money runs fast in and fast out. Strategic money moves slower, but can be sticky. Anchor 3, the term structure and financing incentives. When markets are stressed, relationships between spot and future prices can shift in ways that reveal scarcity, carry costs, and urgency. You don't need to become a derivatives nerd, but you do need to know that these relationships exist and they matter. Anchor 4, the monetary backdrop. Not just nominal rates. Real yields, currency strength, liquidity conditions, and policy credibility. Metals are sensitive to the market's perception of money. If the market thinks cash is becoming more valuable, metals can get hit. If the market thinks liquidity is coming back, metals can rip. And those perceptions can flip fast. Anchor 5, volatility itself. Not as a vibe, but as a regime signal. Volatility clustering tells you whether you're in calm waters or in rapids, and silver loves rapids. Now ask yourself, did any of these anchors fundamentally change in the last few sessions? No. What changed was positioning and leverage. What changed was how crowded the boat was and how many people got thrown overboard when a wave hit. And that's why the "it's impossible" narrative is so damaging. It makes you think the whole system is broken. In reality, the system is doing what systems do under stress. It forces weak structures to collapse. Now I want to bring this back to you, the viewer, in a way that's actually actionable. Because if you're still watching, you're not here for poetry. You're here because you want to avoid getting wrecked. First, stop treating volatility as a verdict. It's a symptom of disagreement, leverage, and repositioning. Second, decide what game you're playing. Are you trading? Are you investing? Are you hedging? Each one has different rules. If you're trading, you can't pretend you're investing when it goes against you. If you're investing, you can't pretend you're trading every dip and rip. Mixing games is how people blow up. Third, size like a grown-up. If a 30% move makes you panic, you're oversized. Period. Silver can do that. The market doesn't care whether your nervous system can handle it. Now, before we go further, check the description. It includes bonus links, including a premium WhatsApp channel link and a channel membership join link. If you want the extra updates in the community layer, it's right there. And speaking of membership, we also offer members-only videos produced by a separate team with more research and deeper digging. Those videos are only for premium members, and they're made for people who want the longer, more detailed breakdowns without the noise. All right, back to the main thread. Let's address the claim that volatility is exactly what you want. That's only true if your thesis requires repricing and you can survive the path. Volatility is not automatically your friend. Volatility is a tool the market uses to transfer wealth from the impatient to the patient. It punishes leverage. It punishes overconfidence. It punishes people who can't hold through discomfort. So the right framing is, volatility is the price of admission. If you can pay it, you can participate. If you can't, don't pretend. Now, here's a cliffhanger that people miss. The most important signal isn't the huge down day. It isn't the huge up day. It's what happens after the rebound, when the market has a chance to breathe. If volatility collapses and price stalls, that can be a sign the repricing energy is fading. If volatility stays elevated and price keeps making progress despite pullbacks, that suggests the market is still in discovery mode. The difference is subtle, and it's exactly why most people get chopped up. Now, let's bring in some fresh context that wasn't in the competitor script, because you asked for more than a rewrite. From recent market updates and publicly available filings across the sector, the broader metals complex has been influenced by shifting expectations around rates, inflation, and currency strength, but also by real-world industrial build-outs that aren't going away overnight. Solar installations, grid upgrades, and data infrastructure trends create a baseline bid for conductive materials. And even as technology evolves, the scale of deployment matters more than a single tweak in intensity. So you have two forces: structural demand that's strong and adaptive behavior that tries to reduce intensity. The price path becomes a tug of war, and tug of wars create volatility. Now, I want to ask you something, because this is where the comments become valuable. When you saw the big down move, what did you do? Did you sell, freeze, or buy? And more importantly, why? Drop that in the comments. And if you're successful, share your success story in the comments so others can stay motivated. Seriously, one real story can keep someone from making a panic mistake. Now let's zoom out historically, because silver has a habit of replaying certain patterns, even if the exact headlines change. We've seen periods where silver goes quiet for a long time, then it wakes up and moves violently. We've seen episodes where leverage builds, then margins tighten, then a liquidation event hits. We've seen times when the public gets excited, then the market punishes excitement, then it resumes the bigger move. The lesson is not that history repeats perfectly. The lesson is that certain mechanics rhyme: leverage, liquidity, and crowded positioning. And that's why I don't get hypnotized by one candle. I look for the plumbing. Now, let's talk about what could happen next, because this is where people either get disciplined or they get reckless. Scenario 1. The market stabilizes, volatility slowly compresses, and silver trades in a range while the macro backdrop digests. In that case, you might see people declare victory or defeat prematurely. Don't. Range phases can be the market reloading. Scenario 2. Volatility remains elevated and you get another liquidation wave. That can happen if leverage rebuilds too quickly or if another macro shock hits. If you're not prepared for this, you'll get emotionally punished twice. Scenario 3. The market continues repricing upward with violent pullbacks. That is the classic path of a revaluation. Surge, pullback, surge, shakeout, surge. Not comfortable, but common. Now, here's where I'm going to be blunt. If you're trying to time the exact bottom or top in a market like this, you're playing a game designed for you to lose. The people who can consistently play that game have better information, better execution, and better risk controls than retail. Your edge is not in speed. Your edge is in patience and positioning. So what moves actually make sense for normal people? 1. Reduce leverage. If you're leveraged in something that can do a monster move against you, you're volunteering for forced selling. Don't be shocked when it happens. 2. Define your horizon. If your horizon is weeks, then you need to accept you're basically trading volatility. If your horizon is years, then you need to stop reacting to weekly drama and focus on whether the longer drivers are intact. 3. Pre-decide your risk. Know what would make you change your mind, not price went down, something structural, something in your anchors. Now, I'm going to loop back to those Sigma memes again because they're not just wrong, they're dangerous. When people say the simulation is breaking, what they're really doing is outsourcing responsibility. They're saying, I couldn't have planned for this. But you can. You can plan for tail risk by sizing and by accepting that fat tails exist. It's not glamorous, but it's how you survive. Let me give you a mental picture that's different from the competitors. Think of silver like a crowded highway with sudden weather changes. In clear weather, everyone drives fast and close. Then the fog rolls in, someone taps the brakes, and suddenly there's a chain reaction pileup. The crash isn't proof that cars stopped working. It's proof that the spacing was too tight. Crowded positioning is tight spacing. Margin hikes and volatility spikes are the fog. Forced selling is the pileup. And after the pileup, the road eventually clears. But the people who drove too close are gone. Now remember I said I'd give you the signal that would genuinely worry me? Here it is, and I'm going to keep it simple. If we see volatility die, price stop making progress, and the evidence of tightness ease at the same time, meaning the market feels comfortable again, then I reassess the repricing narrative. Comfort is not your friend in a repricing story. Pressure is. But right now, we're not seeing comfort. We're seeing pressure. We're seeing disagreement. That's why the moves are violent. Now, I want you to think about your own behavior, because the market exploits the human pattern. Fear after a down day, greed after an up day, recency bias, overreaction, then regret.
These are the facts, not put out by mainstream media. If you want to know the truth, we put out the truth every single day, Monday to Friday. Saturdays and Sundays we spend with our families, as we should do. So if you want to know the truth, come to charlieward.com and see real news daily. And join the Insiders Club, which is live on Wednesdays and Saturdays. Noble Gold for those that are based in America and Canada. And for those in the UK and Europe, we have Allvesta. Get yours now at charlies.gold.